Hi there, thanks for tuning in. Today we're going to be doing an analysis and valuation of Jazz Pharmaceuticals, a pharmaceutical company as the title says. And let's just begin. Now, Jazz Pharmaceuticals says that their purpose is to innovate and to transform the lives of patients and their families. They develop life-changing medicines for people with serious diseases, often with limited or no therapeutic options, so they can live their lives more fully. And essentially, they want patients with a high unmet need. They want to grab and develop those solutions for those needs that are unmet for these sort of afflictions or things that are affecting this large population of patients. And then they want to do that globally. They want to expand. They want to use their current divisions and their upcoming research and development to do that and to keep expanding and hopefully helping a lot of people. And what they do now mostly centers around neuroscience and oncology. However, they are developing a few other products in other categories. So essentially, they're a biopharma company that has been growing a lot. They essentially grow a lot in their oxybate franchises. They now have some cannabinoids as well that have been growing. They have a compounded annual growth rate of 18% for their revenue from 2017 to 2022, which is actually really, really impressive. And likewise, they have been launching 11 products since 2015. They have some projects in the pipeline, and they have acquired some new programs as well. They have some licensing deals. They have market supplied globally, which is great. So essentially, they're a biopharmaceutical company that's growing. That is what they're saying. And they are a smaller biopharma company. They're not one of the big names that I feel like people would recognize when pharmaceuticals are mentioned, but they are a very high growth one, which makes it a very interesting one to analyze as well. So here's their pipeline as well. We see that there's a lot of stuff in preclinical, phase 1, phase 2, phase 3, and regulatory approval. And here are all the different categories as well. Some neuroscience drugs, a lot of oncology, some cannabinoids as well. So it's essential for a pharmaceutical company to always have new stuff in the pipeline and always get new approvals. And there is a lot of sensitivity there where if you invest in a pharma company that does this much research and creates these many products, you may want to keep track of all these approvals. There may be a downturn in the stock, at least in the short term, if something does not get approved and it was expected to get approved. There may also be downturns regarding patents. Those things can be tricky. And so it's important to keep track of this if you're going to be a shareholder of Jazz. It is going to be very important, as a matter of fact, because they're showing you here essentially what their drivers will be for the future, right? And they want to also deliver value through strategic capital allocation. What does that mean? Well, they have some cash from operations, they have some cash equivalents, and they essentially want to diversify their revenue base, keep growing it. They want to maybe acquire some products or companies. They want to deleverage the balance sheet a little bit and expand to different geographies, essentially. So yeah, it is growth. It is finding the best way to grow with a smart approach to it, right? Not just throwing money at things and hoping that it works that way. But yeah, essentially very growth-focused company, and here are the numbers behind them. So their oxybate drugs are essentially their most popular ones in terms of how much revenue it generates, at least in terms of single drugs. Their neuroscience also generates a lot of revenue. And in general, their most popular drug, Xyrem, has actually seen a decline, but we have other drugs such as Xywav that are going up in the amount of revenue that they generate. And most of these products have grown in revenues compared to 2020 and 2021, as a matter of fact, at least those that did exist in 2020. So the overall mix here from 2020 to 2021 was a 31% increase in revenues. Now it's a more modest 18% in revenues. That makes sense. But hopefully we want to see this trend continuing. We'll see, right? And in general, this is very interesting because they have decently high revenues and their cost of revenues are barely anything. However, their operating expenses are incredibly high especially they do have very high SG&A. They have high research and development, and that's going to grow, right? SG&A may stay stable or even decrease a little bit if they want to get efficient at that, but they are a research and development company. They create products, so they have to spend a lot there. So that's going to keep growing. But they also do include these extra items such as intangible asset amortization and impairment charge, acquired in-process research and development. So their operating expenses in their 10K does look higher than if you were to search it at a website such as Seeking Alpha or Yahoo Finance. So that's something to take into account. Here, for example, in 2022, they had a loss from operations actually, while in other years, maybe they had income from operations. So that's something to just keep in mind as well. And they also aren't a company that necessarily generates a net income every year. They do sometimes, but they really don't every year. And that is also something to keep in mind. It isn't always necessarily their priority. Their priority right now with growth may be to just keep expanding, keep finding new avenues, keep diversifying. But it's something we want to keep in mind, right? And they also give us a revenue guidance, which I will be using with my predictions. So their revenues are going to be between 3.675 billion and 3.875 billion of US dollars. And they also give you the sort of breakdown here. So oncology is probably going to even decrease a little bit, but neuroscience is going to increase in their market share there. So that's something, or it's going to increase very slightly, the oncology. But yeah, so it's just important to keep in mind with how these things are going to go. So Xyrem is going to continue to decline. Xywav is going to be adopted, though, so they are expecting it to be adopted instead of their most popular drug, which happens. And they also have a few other guidances here. For example, as we were talking about, research and development is going to grow, and it's going to grow a lot. And that simply is also to drive all these projects that they have. It makes sense, right? SG&A, on the other hand, they're trying to tame it, and that makes sense. If you want to keep your operating expenses reasonable, then, and research and development is growing, well, you're going to have to tame SG&A somehow. They're also forecasting a positive net income. I don't know if this is an adjusted number. I frankly am not looking at this too hard, but it is good to know that they at least want to be positive, right? And that's something we want to see. But that is going to depend a lot on whether or not they successfully tame SG&A and on a few other factors such as revenue growth materializing at high numbers, which is what they have had before. And with this, we can make a discounted cash flow valuation. Now, what I did was I compared what percentage of revenue usually gets turned to free cash flow, right? Which is simply their cash from operations minus their capital expenditures. And it's great also because their cash from operations does not have much stock-based compensation as part of the mix. So that is good to know. But regardless, usually it's a pretty consistent 34% of their revenue gets turned to free cash flow. So that's the number I'm running with. And then everything else, I basically grab for 2023, their guidance that they're giving us about 3.7, the lower band of their guidance, 3.7 billion US dollars in revenue for 2023. I get 34% of that. Then I give them essentially what is a 5% growth rate for the next couple of years. And then I give them a terminal or perpetual growth rate of 2% and a required rate of return of 11%. That's making 1% more per year on the market, which is on average a 10% return for this example's sake. Now that, divided by the total number of shares out, would give us a value of $235.17 per share. However, if then we subtract the net debt, that because they do have a significant amount of debt from the total value, then the fair value that we actually get is $162.64 per share, right? So that's the fair value I'm getting. Where's Jazz now? Well, it recently went through a downturn, and you can see that if you've owned this for the last 5 years, you may not be that happy, but there's also been significant points where you can buy Jazz and see some nice returns, and there's points where you probably shouldn't buy Jazz, right? That shows that at this value that I'm getting of 162.64, there were some points here where it's around 170 where it just doesn't make sense to buy Jazz. And Even here, I think it would have made less sense to buy at any of these highs because there wasn't as much growth in the revenues. It was a smaller company back then. Still is a decently small company with a market cap of 8.12 billion US dollars. However, now it's looking maybe, possibly interesting with this recent downturn, right? Now, let's talk about the margin of safety, and let's talk about also what drives value for Jazz. They don't have dividends, and they don't have share buybacks. They actually do have a decent amount of dilution, so that's something to keep in mind. So the value will depend solely on growth, and that is also what they say in their investor presentation, which is what I've been showing. They want to grow, they want to focus on growth, they want to focus on sustainable growth, and just keep doing that as much as they can. In fact, they say their vision for 2025 is to get to $5 billion in revenue. Will they do it? I don't know, but it's interesting that that is their main objective right now. Now, their revenue growth is really healthy, and in fact, I may be giving them a little less revenue growth per year than is fair because before they've been doing double digits of revenue growth pretty consistently. I'm just saying they're going to not grow that much next year and then grow by 5% and then by 2% in perpetuity. That may be a little unfair. However, there are some risks involved, right? Pharma franchises can be incredibly valuable, but they can also be disrupted. They may have an incredible product that helps a lot of people, but maybe another company that is researching similar things can make an even better product. And then what, right? So they do have a moat because the valuable products, patients will keep using that. And that's something that's very important. It's a little bit of a sticky source of revenue. And if they have multiple of those, that is amazing. They have diversification among many products, which we love to see. But it's not unbreachable, as in their most popular products can be threatened, and thus the revenue can take a dip if those products are threatened or if better products are released in the market by other companies, right? So they have a lot of fixed costs. They have a non-negligible amount of debt. They have moat, but it's not a truly unbreachable moat. I'm just going to, for example's sake, give it a margin of safety of 25%. So we're going to grab the original number we got for fair value and just multiply it by 0.75 to get the fair value after the margin of safety, which is what I would buy it under. And that would give me 121.98 US dollars per share for the value I would consider buying it under. And we're not far away from that. So that is interesting. I think Jazz is something worth looking at, worth tracking, worth diving deeper into, because this opportunity, this recent dive it's had, it may not be there for long. And if it makes sense with some further research, I think that's great. Now, I must ask though, or I must just tell you rather, you should invest in what you understand. Pharma is something where you're going to have to keep track of those products that are in the pipeline. You are going to have to keep track of any disputes with patents. You're going to have to keep track of competition. So Jazz is something where I think if you do your research, if you put your time into it, you'll be able to understand it. But just make sure that you do understand it before you invest in it, because pharma is not the easiest business out there, and it has its very unique points of strength, but also its very unique challenges. So whether or not Jazz can keep delivering, well, that is something that will require further research to estimate. But I do think it's a very interesting company, and if you understand it, it can also be a very interesting opportunity at the time. Now, with that said, I hope you enjoyed this video. If you have any questions, feel free to comment down below. I will try to respond to every comment. And if you want to see more like this, please let me know any stock you would want me to analyze. I'll be happy to check them out. So with that said, thank you for watching, and I hope you have a great rest of your day.